Let's start chapter number 18, which is incomplete records. Now, this is your last chapter from sole trader business, sole proprietor accounting. Up until now, whatever chapters we have done, our main focus was on preparing accounting records for the sole trader. As we discussed earlier, that sole proprietor or sole trader, it is usually a relatively small business, probably a small shop, maybe a small restaurant, maybe a small cafe. And such a small business, they do not have a full-fledged working accounting department. So they don't have qualified accountants. Probably they do not have the accounting department, and sometimes they do not even have one accountant. All they have is a cashier who is just receiving cash and recording some kind of information. And sometimes they outsource their accounting to some other accountant who would come once a week or twice a week and do accounting for them. So in such situation, what happens that the accounting records are never complete because you don't have proper accounting department functioning. So it means that all of the information is not properly recorded. So they do record some information, but it is not complete, and therefore we call it incomplete records. But at the same time, they have to prepare their financial statement, income statement and balance sheet, and they need to calculate all that missing information. So there is a lot of missing information. So we need to find out or calculate the missing information based on the available information. Whatever they have recorded, they will use that and they will try to find out the information which was missing or which was not recorded. Now this chapter is more of mathematics and less of accounting. So you will use a lot of your mathematic knowledge mixed with accounting knowledge. So we start the chapter. It says the problems likely to arise. Usually what happens in such businesses that cash sales are not recorded. Sometimes credit sales they record very carefully, but it is possible that some customer comes in, he pays $10 and he buys something. So you give him the product and you take the $10 and you put the $10 in cash. So sale is complete, but somehow it was not recorded. The sole proprietor, he just forgot to record it in the books. Drawings not recorded, because we know that in sole trader we have one thing which is called drawings, and it is possible that he takes some goods for personal use. Probably he also takes some cash for personal use, and sometimes he would record and sometimes he would simply just forget to record. And thefts of cash or inventory, it is also possible. It is a small business. It does not have very strong control systems. So stealing or theft is possible. Inventory not counted at year end. This is a very common problem with sole traders, with small businesses. They do not have such a system, and they also do not have resources to calculate their inventory at the end of every year. So it is possible that they calculated half of the inventory or some part of the inventory, or probably they did not calculate at all. So inventory, when you do not calculate at the end of the year, you know that inventory we use in income statement and we also use while making our balance sheet. So if your inventory figure is wrong, it is underestimated or overestimated or probably not available, in this case your income statement and balance sheet will also be wrong. So inventory is an important issue to be calculated at the end of the year. The records that are likely to be kept would include. Now we said that some of the information he has and some he does not have. So in the previous slide we saw that information which was missing or which was not available, but usually what information they keep with them is bank statements are available. Even if bank statements you have missed out, you can go to the bank and you can get a copy of that. Then till rolls. Till rolls, these are your checks for, from that your cash teller machine. So when you put cash into the cash teller, it takes out some small check that is called till rolls. Till rolls are available and they are also in the memory of your cash register, so you can generate them and you already have them many times. Supplier invoices and statements are available, and even if for some reason you have lost some invoices or statements, you can always go to your supplier and get a copy of them. Sales invoices and statements are available. They are available with you, and also your customers also have a copy, so these are not an issue. You usually have your sales invoices and statements. So Understand and apply techniques used in incomplete record situation. How do we calculate it? We say use of accounting equation. I am going to show you in the next slides. If you remember your accounting equation, assets is equal to capital plus liabilities, and then use of ledger accounts to calculate missing figures. We have sometime your ledger balances for purchase ledger or sales ledger or receivable ledger, etc. So we will use multiple ledgers. Like I told you that it is more of mathematics. Just imagine if I tell you that A is 5 and B is 10 and C you do not know, but A is 5, B is 10, C you do not know. But if I tell you that A plus B plus C is equal to 20, so now if I tell you A plus B plus C is equal to 20, you can easily find out the value of C out of that. Knowing that A and B, C can be found out. It is same. You can also consider another example that you have done it before, that cost of sale is equal to opening inventory plus purchases minus closing inventory. So these are 4 items. Cost of sales is equal to opening inventory plus purchases minus closing inventory. If any 3 numbers are given to you, the 4th number you can calculate yourself. So this is what we say, that use of ledger accounts to calculate the missing figures. Use of cash or bank summaries, you can do cash book and bank statement, and profit percentages. This is very important, and we are going to explain you in detail how to calculate profit, how to use profit percentages to calculate the missing figures. We are going to do some 5 or 6 examples as part of this chapter. I mean, this chapter I can only explain by doing some examples. This is your chapter summary. You have margin, you have markup. I'm going to discuss what is margin, what is markup. These are called cost structures. You have techniques for solving incomplete record. You use your sales books, purchases books, and drawings and inventory. So what type of questions usually come? An incomplete record question may require competence in dealing with one or more of the following: preparation of accounts from information in the question, theft of cash, which is balance on the cash in hand account is unknown, theft or destruction of inventory, which means closing inventory is unknown. So they will tell us that this was opening, then this much of theft has happened, and you have to calculate the closing inventory, etc. Calculation of profit. By profit is the increase in net assets. So here we will use our business equation. We are going to show that as well. We have discussed it earlier. You have 2 equations. One is your accounting equation, asset is equal to capital plus liability. One is your business equation in which you say that profit is equal to closing capital minus opening capital, plus drawing minus capital injections. I'm going to discuss this equation also. And calculation of year-end inventory when the inventory count was done after the year-end. What does that mean? That you may have to, actually you should calculate your inventory on 31st of December. But then what happened that the sole trader, he just calculated inventory probably on 10th of January. So 10 days you were late in calculating your inventory. So you should have calculated on 31st of December. You missed the date and you then calculated on 10th of January. So based on the information available on 10th of January, we need to calculate what was or what it would have been on 31st of December. So we will just add, subtract purchases and sales, etc. We will do some questions on that. You've got accounting equation where assets minus liabilities is equal to proprietor's capital, or you can say that asset is equal to capital plus liabilities. And you have closing capital is equal to opening capital plus profit minus drawing. This equation we did in chapter number 5. And there is one more thing which you say that profit is equal to, now this is the same of this, I'm just changing the name. Profit is equal to closing capital minus opening capital plus drawing. This is the same, I'm just rearranging these things, minus capital addition. Capital addition means that if you have added some capital during the year, it must be added into it. So now we speak about markup and margin. So actually markup is a profit percentage which is calculated on cost price. So whatever is the purchase price, for example, if you purchase something for $100 and you want to make a profit of 20%, so you say $100 is cost price, 20% means $20, and you sell your selling price as 120. So cost price, if you multiply with some percentage, that is called markup. Margin, on the other hand, that's a profit percentage calculated on the selling price. So for example, if you see one product which is sold for $200 and you are told that there is a 20% margin on that. So 20% margin means 20% of the selling price. So markup is calculated on cost price, margin is calculated on the selling price. Let's see some simple numbers how it works. For example, you purchase some product for $1,000. Maybe you purchased a computer and you want to sell it on some profit. So you add some profit. You say, I want to make 30% profit on the purchase price. So $1,000 is your cost. You multiply it by 30%, which is $300, and you set your selling price for $1,300. Now you've got a friend and he says that, give me some discount. Whatever profit you added, just subtract it. So how much profit did you add? And you say, I added 30%. So you say, okay, let's subtract 30%. So he would say 1,300 multiplied by 30%, which is 390. So when you subtract it from here comes only 910. And of course, the 910 was not your cost. You would say, you see, I bought it for $1,000. And probably your friend would say, you see, you asked me to make 30%, I just took 30% of that. But the confusion is that you were taking 30% of 1,000 and your friend was taking 30% of 1,300. You were talking about markup and he is talking about margin. So 30%, if you take it from 1,300, that is called margin. 30%. 30%, if you take it from 1,300, this is called margin. But 30% if you take it from 1,000, that is called markup. So whenever you are faced with a situation where somebody says that profit is 20%, you must ask, what is this? Is it 20% markup or is it 20% margin? Because these two are different numbers. So how do we mathematically calculate it? The rule is that a margin is where gross profit is expressed as a percentage of sales. Like I said, that margin is percentage calculated on sales price. And what you set the rule, just remember this rule, that set sales is equal to 100% because margin is on sales. So sales price you keep at 100%. If your gross profit is 25%, your cost of sale will be 75%. So in case of margin, selling price is full 100 and cost is less than 100. Cost is within 100%. That is for margin. But if you go for markup, you say that a markup is where gross profit is expressed as a percentage of cost of sales. So here what you've got the rule, because it is a cost of markup is on cost of sale. So you set cost of sale as 100%. And if gross profit is 25%, selling price would be more than 100%. So in case of margin, 100% is maximum for sales, cost is below that. In case of markup, cost is 100%, selling price would be more than 100%. And you can see it, I'm repeating it again. And just I put a comparison here that why did I put it? You need to see that in case of margin, sales price is 100%, cost is less. In case of markup, sales is more than 100%. Sales price you multiply with 125 or 1.25, whatever. So this is the case of markup and margin. Now what we need to do some examples. For example, they tell us that your sales are $476,000 and gross margin is 40%. So we are saying margin, it means that it must be calculated on the selling price. How much is the cost of sales? This is what you have to find out. So you go back to your rule, you say that sales, cost of sales. Because this is an example of margin, so I would say that sales is 100% and my profit is 40%. Therefore, cost should be 60%. And this 100% is equal to 476,000. And therefore, the cost would be multiplied by 60%. Answer should be 285,600. It's very simple. Simple mathematics. Let's do one more example. Credit sales for the period. Gross profit is 30% markup. Cost of sales they have given us 257,000. Cash sales they have given us 43,540. And we have to find out credit sales for the period. So what you can do, they told you the cost of sale. Based on cost of sale, you add up your gross profit, which is markup. You will find out total sales. From total sales, you will subtract your cash sales and remaining would be the credit sales. So cost of sales, using the markup formula, I will find out my sales value. From total sales, we would subtract cash sales, and what is remaining, that would be your credit sales. So let's do it like this. What they have given us in question, they told us that it is a markup question. The rule is that you set cost of sales as 100%. Your profit was 30%, so sales value would be 130%. This 100%, they gave us $257,000. And you multiply it with 130, it is 334,100. Now this is the value of total sales. So your total sales are 334,100. And from this number, you subtract your cash sales, which they gave in question, 43,540. The balance is your credit sales, and that will be your answer, 290,560. Let's do one more example now. Example number 3, purchases for the year. So what they told us is gross profit, which is in terms of markup, sales value, opening inventory and closing inventory. I know that from gross profit and sales, I can find out cost of sales. You know, this is total sales value and there is a 30% markup. So you can find out cost of sales, and then you will have cost of sales, opening inventory, closing inventory. We can easily find out purchases because we remember that formula, that cost of sale is equal to opening inventory plus purchases minus closing inventory. So once we find out our cost of sale, purchases would be easy. So let's do how to calculate your cost of sales. So in this question, they told us sales value 221,000, markup is 30%. So because it is a markup case, I put cost price as 100% and sales price as 130%. This is 221,000. They have given this to us and we have to convert it here. So we just multiply with 100 and divide by 130, or you can simply divide with 1.3. You can simply 221 divided by 1.3. You will get 170,000. Now that is your cost of sales. And then we put it in our formula, opening inventory, which is 43,000. Purchases 174,500. This actually is your balancing figure. So what you do, first you fill in these numbers, 43,000 plus X minus this is equal to 170,000. So this 174 you calculated, that's why I put it in italics, that this is the balancing figure, because you use the formula opening inventory plus purchases minus closing inventory is equal to cost of sales. One more example we will do now, which is example for sales for the period. So they gave us opening inventory plus purchases minus closing inventory. We will calculate our cost of sales, and then using cost of sales and the margin, we can find out our sales for the period. Very simple question. So it's a question for margin. So we put sales as 100% and gross profit was 35%. So cost of sale is 65%. This is the formula. But first we find out how much is our cost of sale. So opening inventory purchases minus closing inventory is equal to cost of sales. So you just put numbers and you get cost of sales as 179,660. Now you put 179,660 here, and this is only 65% of the total value. So how do you calculate? Multiply with 100 divided by 0.65, or you can simply divide this 179 with divided by 0.65 and you get to the sales value. This is very simple mathematics which you have already done in past. It's not something very difficult or technical. We do one more question. This time it is purchases for the period, and they told us opening balance, closing balance, cash paid and payment from bank. Now that's not a question of markup or margin. It does not involve markup margin. It involves your ledger accounting. So there is some ledger for which you have some opening balance, closing balance, cash paid and payment from bank. So you need to find out which is this ledger. So sometimes students, they think that it is purchase ledger. It is not purchase ledger, by the way. It is because purchase ledger is an IS ledger, and you remember that IS ledgers, income statement ledgers, they do not have opening balances. You have been given opening balance and closing balance. Opening balance, closing balance does not appear in any IS ledger, in purchase ledger. Purchase ledger always start with 0. No opening balance. So this is opening balance is not for purchase ledger. This is actually for your payable ledger control account. This is your payable ledger. Just like you have a sales ledger and receivable ledger related, similarly purchase ledger and payable ledger. So this is my payable ledger, which is a liability ledger, and I have an opening liability of 38,450 and a closing liability of 43,825. And during the period we paid some cash to the supplier, and we also make some payment from the bank. So we make our ledger like this. It is purchase ledger control account, and we've got opening balance 38,450 and closing balance 43,825. And whenever we will make any payment, our liability will decrease, and decrease in liability means debit. So you debit the payable ledger when you make some payment. If you pay to your supplier, your double entry is debit payables credit bank or debit payables credit cash. So we have to debit it. All of the payments which we will make, those will go onto the debit side of the ledger. So you made payment from your cash 430, it will decrease your liability, so you make debit. Then you made a payment from bank which is 167, again it will decrease your liability, so you make total on both sides of the ledger. So this side of the ledger is bigger, so we write it down on two sides, and this makes 211,000. This does not make 211. The difference between these two numbers, that would be your purchases, because purchases increase your liability. When you make purchases, your double entry is debit purchases credit payables. So debit purchases credit payable, which means purchase ledger credit, purchases debit. So these are the goods 173,029 which you purchased during the period. So that's all what it is. So now this is the end of this chapter. This was not a very difficult chapter. Questions are also not very difficult, just need to do some practice, and let's move to the next chapter now.